It is now almost 6 years since Lehman Brothers collapsed, 6 years of extraordinary monetary policy, and as we speak, there is still no end to massive intervention from central bank. Admittedly, the Fed will terminate its so-called QE program in October, but at the same time, the ECB is considering additional measures. And indeed, recent economic indicators point to a stunning divergence between the US and the Eurozone economies. On the one hand, the Eurozone growth was zero in the second quarter, with structural weakness in France and Italy being compounded by a slowdown in Germany, while in the US, the economy is gathering momentum with solid employment gains and rising economic indicators. In addition, the standoff between Russia and Ukraine is much more of an economic threat to the Eurozone and Germany in particular than to the US. Finally, on the inflation front, in the Eurozone, inflation is up 0.3% year-on-year, almost zero, well below the ECB 2% target, while in the US, headline inflation is close to 2%. It is no surprise that the Fed and the ECB have started to follow a different path. We expect the Fed to raise interest rates in the first half of 2015, but at the same time, not only the ECB will stick to its zero interest rate policy for a very long time, it is even likely to implement new measures. We believe investors can benefit from such a divergence, and we list 4 major opportunities. First, the US dollar should continue to appreciate against most currencies, and finally, it should have turned the corner against the euro. We continue to recommend a strategic overweight of US dollar in European portfolios. Second, as ECB action is bringing down the level of interest rates in the Eurozone, the spread between the yield of Bund in Germany and US Treasury is moving into record territory. This is the reason why we recommend to add exposure to long-term treasuries. They have a reasonable running yield and they are denominated in US dollar, which is attractive from a European perspective. Third, ECB action, everything being equal, is likely to support equity markets, provided corporate earnings remain robust. Last but not least, the situation where the Fed is tightening gradually, but where the ECB is easing should benefit emerging market assets and local emerging debt in particular. Such securities have a running yield of almost 6.5%, which compares very well with other fixed income alternatives. Admittedly, 2013 was a difficult year for emerging markets, but the most vulnerable countries have implemented measures to stabilize or even improve their current account deficit. As a result, we expect local currencies to hold up reasonably well, at least versus the euro and the Swiss franc. In conclusion, even though geopolitical risks are still multiple and global economic growth outside of the US has slowed down somewhat, central bank policies remain extremely accommodative, lending support to financial markets. We stick to our overweight toward equity markets, but are mindful of our price targets and will be ready to act if these price targets are reached.